Welcome to our presentation. Our group will talk you through two accounting methods when accounting for equity investment: equity accounting and consolidation accounting. So part one will compare the two accounting methods. Part two will discuss how managers can benefit from choosing equity method over consolidation. Part three will explore few solutions to mitigate manipulation. Part four will analyze the debate over the adoption of a uniform accounting for equity investment. Let's first look at the similarities. Both accounting methods require the parent entity to hold interests ownership in other entities to account for an entity's equity investment. The influence could be in the form of a significant influence or control, depending on the degree of the influence. In addition, an acquisition analysis has to be done at the acquisition date. Furthermore, fair value and intra-group transactions adjustments have to be made under both methods. In addition, both accounting methods record gain at acquisition as well. Let me talk you through their differences. If a firm owes between 20% to 50% of other entities' voting power, then the firm should use the equity method to account for other entities. However, this is not an absolute cutoff point. There are also some other indicators that can prove the existence of significant influence. First, representation on the board of directors. Second, participation in policymaking processes. Third, material transactions between the entity and its investee. Fourth, interchange of managerial personnel. Last but not least, provision of essential technical information. But however, if an entity has control over other entities and owes more than 50% voting power of the company, then the consolidation method has to be used. According to ASB 10, the principle of control includes the following three aspects. First, power of the investee. Second, exposure rise to variable returns from its involvement with the investee. Third, the ability to use its power over the investee to affect the amount of the investor's return. Secondly, the two account methods have to be complied with two different accounting standards. So firstly, ASB standard 120A must be complied to prescribe accounting for investments in associates and joint ventures. According to ASB 128, the investment is initially recognized at a cost and adjusted thereafter for the post-acquisition change in the investor's share of the investee's net assets. The investor's profits or loss includes its share of the investee's profit or loss, and investor's other comprehensive income includes its share of the investee's other comprehensive income. ASB Standard 10 has to be complied when to establish principles for the presentation of consolidated financial statements. It involves combining parent and subsidiaries' income statements and balance sheets together. The parent company's investment in subsidiary gets eliminated against subsidiaries' pre-acquisition equity, while the equity method does not combine the accounts at all. So another difference is that the entities to be consolidated is called subsidiary. The investee under equity method is called associate. In addition, the goodwill is included in the investment associate under equity method. However, and the goodwill becomes the single economic group's asset after consolidation under consolidation method, and also needs to be tested for impairment periodically. Also, and last but not least, under equity method, distributions such as dividends from investee reduce the investment's carrying amount. With debit cash and a credit investment associate, under consolidation method, dividend revenue and dividend paid are both eliminated with debit dividend revenue and credit dividend paid.
Thanks for that. In order for management to utilize the equity method, the investee must be under significant influence or be part of a joint venture. A significant influence is the power to participate in the operating and financial policy decisions of an entity. Typically, this is when an entity owns between 20 to 50% of or more of the voting power. And it is also considered to have significant influence of where they have board of directors representation, where basically their own employees are listed as board members. Management personnel swapping or sharing, so this is more at an operational level. Material transactions with the investee, where you have upstream or downstream transactions in between the investee and investor. Policy-making participation, so anything from operating policies to public policies. And technical information exchanges, where one company, such as the investee, being specialized in a specific area and can offer services to the investor. These somewhat vague descriptions of significant influence can lead to a lot of ambiguities. We'll look at through them in this scenario. So in scenario 1, the entity is a wholly owned or partially owned subsidiary of another entity. Along the whole rabbit train of subsidiaries being owned by another parent company and that parent company being owned by another, being classified as a subsidiary of another parent company, can lead to a whole lot of trains of we don't actually know how to classify it, and they can use the equity method. In cases where the entity that's purchased the investee is a subsidiary of another parent company, they don't have to use the equity method and can use consolidation. In scenario 2, the entity does not have personnel on the board of the investee, but can influence the decision making of hiring new board members. So what constitutes significant influence can vary. For example, whilst they may not choose the ultimate person to hire, they can point them in the right direction and give recommendations on who they think should be part of the new board member. And the last scenario is when they have less than 20% of voting shares, but has the potential voting rights through share call options. Now, this is at a specific time when you're analyzing the investor entity, where they, for example, may have 10% of voting shares, but they hold another 10% in call options that can be redeemed in the future, not at the moment. So whilst at the moment they have 10% according to the 20% case rule, where you look at the investors' share options at the moment, but that can be redeemed in the near future if they decide to hold on to them, and obviously they will have significant influence. Right, so what does that mean? So potential exploitation of the equity method. Right here we have a diagram where we look at basically the whole cycle. Right, so in the beginning at acquisition, the entity acquires the investee through raised capital, or however way they finance it. In the second part, we have increased performance, where under the equity method, assets and revenue are artificially inflated, leading to an inflated return on assets or return on sales being overvalued. Basically, this leads to more unknowing retail investors or investors being somewhat misled in that they look at these metrics and think that they overvalue the company. This may lead to a higher share price. And obviously, as a consequence of that, management may receive extra remuneration because of this perceived increased performance. However, we all know that obviously they haven't, they've just bought another company. And this leads to more acquisitions because of the raised capital through generated share capital.
So let's walk you through some solutions to mitigate potential manipulation. So first, the solution is that financial managers' performance should not be evaluated based on financial ratios that are calculated based on parent company's earnings and that include associates' profit on the equity method. That's because financial managers can manipulate earnings to boost financial ratios such as return on equity, earnings per share. And therefore, the firm's bonus system could reward a financial manager based on the parent company's regional ratios without incorporating associates' profits. This could reflect a genuine financial ratio and allow companies to assess their financial managers' performance more accurately. So as a result, financial managers are not able to hit bonus target through the manipulation by choosing the equity method, as their performance now is judged on the regional financial ratios. This could prevent unwanted managed behavior and help the company operate more efficiently and effectively, hence boost investors' confidence.
Solution 2. One aspect of equity method that allows managers to mask underlying economic problems is that it is a one-line consolidation method. Proportionate consolidation method when the investor's voting power in the associate is close to 50%, can be used to provide more transparency in the investor's reported figures. The proportionate consolidation method includes the investor's share of the associate's assets, liabilities, revenue, expenses, and cash flows in the investor's own financial statements. This will disclose more information than the equity method on where the figures from investment in associates come from. However, Davis and Nage suggest that at the same time, companies may not be in favor of a more open disclosure policies, as there exists the agency problem where the managers' and owners' interests diverge. One of the advantages of having a uniform accounting treatment for equity investment, regardless of the level of influences the investor holds on the investee, is that how the investor's financial statement is presented is standardized. This will enable the public and shareholders to better understand the investor's financial structure and its relationship with its investees. Lee, Pandit, and Willis found that the equity method's single line item recognition of the investor's share of its associates' profits and net asset increases information complexity about the investor's earnings. This is largely due to the lack of disclosure of the investee's earning performance, which would thereby yield less accurate forecasts of the investor's earnings. Hence, increased accuracy of the investor's earning forecast can be achieved by a uniform accounting treatment with more disclosures. Another opponent to use of equity method is that it breaches the realization principle. The realization principle, along with the traditional notion of conservatism, states that expenses should be recorded when they're discovered and revenue when they're fully realized. By including the investor's share of the investee's profit in its statement of profit and loss, even if no dividend is paid and may not be paid for some time, is argued to be overstating the investor's profit by Deegan. While the investor with significant influence over its associate is able to contribute to company policies and decisions, they ultimately do not have the final say, and therefore the investor does not have the control over how the investee's profits will be spent. On the other hand, uniform accounting treatment, regardless of whether an investor owns minor investment in investees and have no influence on company decisions, significant influence or control would mean that the information disclosed by the investor about its investees will be compromised. This is because of the information asymmetry, where the amount of information available to an investor with say 20% ownership will be largely different to that of a parent entity, and the financial report as a result will be significantly limited. Also, the AASB 128 provide reasoning behind the need of separate treatment, specifically for the equity method. It states that because the investor has significant influence or joint control over the investee, the investor should have an interest in the associate's performance and profit. It will not be accurate to report investment with significant influence as only the dividend payout, because the investor does have the power to contribute to investees' profits and decisions. However, it would also not be accurate for the investor with significant influence to do consolidation accounting, as another company with control may be doing so. Therefore, it is not desirable to have a uniform accounting treatment for equity investments, regardless of the level of influence the investor holds over the investee. Uniform accounting treatment would mean compromises in the amount of disclosure available to the public, as the level of information available is different for different level of influences. And since investors with significant influence can contribute to the investee's decision-making, they should claim proportional share of the associate's profit as permitted by the equity method. However, the equity method is susceptible to potential manipulation and should be improved with mechanisms as suggested above. To conclude, we first compare the equity method with consolidation accounting. explain how the equity method can be taken advantage of, then present solutions to mitigate the potential manipulation associated with the equity method, and finally discuss whether it is better to have a uniform accounting treatment and conclude that different treatment is needed for different level of influences. Thank you for listening.